Two. Hi, everybody. Welcome to the Dilyar Kurban podcast. I have a very special guest with me today. His name is Lawrence Raponi, the Vice President of Equiton. Equiton is a real estate firm, a real estate investment firm. I know, Lawrence, thank you for coming to my podcast. Everywhere you can be on a Wednesday morning, you decide to come here. So thank you for that. Lawrence, if you can give us a brief introduction of who you are and little bit about Equiton, that'd be great.
Absolutely. And Dilyar, thanks for having me. It's always good to be reaching out and educating people about the world of real estate. So I'm Lawrence Raponi. I'm an associate vice president at Equiton. And just to say a few words about myself, I've been a real estate investor for most of my adult life. I'm 36 years old currently, and I bought my first property at 23 years old. It was an income property. And today I manage about 12 doors across different markets throughout southwestern Ontario.
Nice.
And pretty well versed on all things investment related, whether it's real estate, of course, but also stocks, derivatives, mutual funds, all that type of things. In terms of what we do here at Equiton and who we are, Equiton is a real estate investment firm that takes the work and the hurdles that are associated with conventional real estate investment out of the equation and really allows people of all walks of life, even with much smaller investment sizes, to get exposure to an asset class that we all know and love, which is real estate. So at Equiton, I like to say that we are a passive and private real estate investment firm. And those are two key words in there that I mentioned, the two P's, passive and private. And I want to take a deeper dive into both of them. So for our investors, we are a passive investment, which means you can participate in the capital appreciation of physical real estate and, more importantly, in the cash flows that these real estate assets generate. But you don't have to manage these properties yourself. You don't have to change the leaky dishwasher. You don't have to vet your tenants for credit quality. You don't have to sign leases or anything like that. Of course, you're leaving that to the professionals at Equiton to do it for you. And we are a privately held company. And that simply means that we're not traded on the stock market. And that has one serious advantage. It creates stability for our clients because our investments don't fluctuate up and down like a roller coaster, as does the stock market, for instance. You're getting an investment that is much more stable and much more consistently performing over time, similar to physical real estate, right? Physical real estate's not going to move around with very volatility. And it's exactly how our investments work as well. Look, I have a lot of these conversations, Dilyar, and in my experience, there's generally three things that keep folks from investing in real estate. The first thing is the massive down payment, right? To buy a piece of real estate in Toronto, at least, or in the GTA, we're looking at a down payment of anywhere between 150,000 to maybe even 400,000 or 500,000, depending on the size of the building.
Yeah.
Second thing, obviously, is financing. And this is especially true in today's market where we're seeing precipitous run-ups in interest rates, right? Mortgages are becoming harder and harder to obtain. Finding financing, particularly if you already have a primary residence, is very difficult to do. And the last thing, of course, is maybe you have a down payment, maybe you have financing, but you just don't want to be a landlord, right? A lot of my clients, they have both of those things. They're quite well off, but they want to enjoy their life. Maybe they're approaching retirement. Maybe they have 3 or 4 children at home. The last thing they want is a part-time job in managing an investment property. And so companies like Equiton come in to offer that same level of exposure to real estate, but without any of the three hurdles that I just previously mentioned.
Nice.
Yeah.
So what kind of real estate investments do you guys look into? Of course, there was, as I mentioned before, multifamily and commercial units. Anything other than that you guys dive into?
Yeah. So at Equiton, we have 3 investments. Okay. However, they're broken down into sort of 2 different styles. So I like to tell my clients we have 2 styles of investments.
Right.
On the one side, we have funds,
Mhm.
and on the other side, we have developments. Okay.
Right.
And they're fundamentally different types of investments. They have different characters, they have different risk profiles, and of course, different returns.
Yeah.
Let's talk a little bit about the funds first because they share some common characteristics, and we'll just touch on them at a high level. We have 2 real estate investment funds that we run at Equiton. And first of all, the funds are diversified. So when you invest in either of our two funds, you're getting exposure to multiple real estate assets within that portfolio.
Yeah.
So you're sharing in the profitability of not just one building, but could be 10, 20, or 30, however many buildings are in
Yeah.
that portfolio. The second thing to understand with the two funds is that both of them produce very, very strong cash flows. Currently, both funds are paying a 6% cash distribution every year, and it's paid to investors every single month. And we've set it up this way because think about investing in real estate. If you bought your own property, your tenants would pay you every month. And so your investment at Equiton in either of the funds will do the exact same thing. It's going to give you monthly liquidity. And the third thing to understand about the funds is that they're liquid, which simply means you can sell them whenever you please. Now, these are generally longer term investments and they are subject to minimum holding periods. I don't want to go too much into that, but we can obviously do that offline. But I will say you can sell them at any time. So you're free to move in and out. Now, the development investments are on the other side of the coin, and they are actually completely different. With these development investments, it's not a long-term buy and hold strategy. It's not a fund. You are actually investing in the physical construction of a real estate asset. Typically, it's either a condo or a subdivision. We're building residential real estate, and we're profiting from the completion and the subsequent sale of that particular development project. So as I said, it's not a long-term buy and hold strategy. We're not renting out these properties. We're building a condo. We're selling all the units one by one pre-construction, as an example, and that is the profit that goes back to investors at day one. Now, these investments, first of all, it's not a fund. You're investing directly into a specific project, okay? So there's concentration there. The second thing to understand is that unlike our funds, the developments do not pay cash flows. Investors are given their profits and their original investment capital back on the completion and the sale of the project. So if you're in a 3 or 4 or 5 year project, you're not going to receive any returns until 3 or 4 or 5 years from now. So we like to say that the returns are backloaded. Okay. And the third thing to understand, this is the last point, is that these developments, they're long-term projects and they are illiquid. You cannot sell them. So once you're on a 4-year project, you're in for 4 years. You can't decide at year 1.5 that you want your money back. You're in to completion. Now, these investments are slightly riskier and slightly more restrictive, right? But you are compensated for that level of restriction with some very, very compelling returns. We are targeting annual returns with the developments of 20% a year. So the rule of thumb is in 5 years, you can double your money. That's generally what we are looking to achieve for our investors. Whereas the funds, they are lower returning. We're targeting anywhere between 8 to 16% annual returns, but they're also far, far less risky. They're more diversified and they provide cash flow. I want to say something quickly about the minimum investments. One of the things that makes us very popular with investors is you don't need a lot of money to come to the table and invest. And that's unique for something in this space. Typically, these types of private equity investments, they have very high barriers of entry. The minimum investments for our funds is as low as 5,000. The minimum investment for our developments is a little bit higher. It's 25,000, but it's still not obtrusive.
So for the investment side, for the pre-construction, of course, you said you're building subdivisions or pre-construction condos. Now, on the fund side, what are you guys investing the funds? What kind of properties you guys are investing the funds to? And also, how much do you guys are managing currently on the fund side?
Yeah, I'll answer that question first. I'll give you a short history lesson about who we are at Equiton and sort of where we came from. We founded our company in 2015, and at that time, we had an original investment of only $1 million. We used it to buy our first apartment building in Stratford. There were 3 employees, and today we have about 185 employees, and we manage just over $1 billion with a B worth of assets. We have over 10,000 investors across Canada, and yes, very, very large firm now. So in terms of the strategies for our 2 funds, the first fund we started back when we bought that first apartment building way back in 2015 is the residential fund. And it's the exact same strategy that many retail real estate investors would employ. You're going to go out, you're going to buy a duplex or a triplex or maybe a condo and rent it out. And that's exactly what we're doing in the residential fund, except at a much, much larger scale, because we don't buy duplexes and triplexes and condos. We buy 20-story apartment buildings.
Mhm.
Generally speaking, we're looking at acquiring assets anywhere between 10 million and 60 to 70 million in value. These are the types of properties we're buying. As an example, we have about 890 million worth of assets in this fund alone. Now, that 890 million is spread out across only 32 properties. So you can get a sense of the size of building we're buying. We are institutional investors.
This is only
And
Canada?
and only in Canada. It is a Canada specific fund. We will never buy anywhere else, and that's written on paper. We can't. So it's part of our mandate.
Okay.
And it's a very simple strategy. It's a long-term buy and hold strategy. We are acquiring residential real estate. We are managing these assets completely internally. We do all of our own property management. We collect rental revenue from our tenants. We pass it through to investors. And our investors also take part in the appreciation of the buildings over time. So if we bought a building for $12 million 6 years ago, and now it's worth 20 million, well, the value of our investors or principal will increase over time as the buildings increase. And we've set it up this way purposely. It's meant to be the exact same as you going out and buying your own property. It covers the exact same sources of value.
Okay.
Now, our second fund is a little bit different, a little more complicated, but a little more interesting. It's a balanced strategy. So in the second fund, it's called the Income and Development Fund. It has multiple real estate assets. So it has different strategies that we employ. And the key here is that it's balanced. We're trying to give investors exposure to real estate strategies that they may not otherwise be able to implement themselves, right? So in this fund, we have three sources of value. We have income producing commercial assets. We have a little bit of private lending. So a portion of this fund is debt. And we also do developments. Okay. But you can think of this fund as broken into two categories. Part of the fund is invested in income producing investments, very low risk, very consistent, very stable. And the other piece of the fund is invested in more higher growth development projects. So it's meant to be a jack of all trades fund. It's a fully diversified investment where you're going to see high growth from the developments, but very consistent cash flow from the loans and the commercial properties.
Nice. How often are you guys going out to pick up these multifamilies or commercial properties?
Yeah, everyone asks that. So it depends entirely on A, the amount of capital we have to deploy, but B, also what the market is giving us. We only buy properties when we see opportunities to do so. We are not in the business of overpaying for buildings. It's not how we deliver the very stellar returns that our investors have come to expect from us. So it depends what the market's giving us. And I'll give you an example just to really hammer home my point. Back in 2022, we were starting to see a crowding around the GTA-based real estate markets, specifically Southwestern Ontario. Things were getting a little expensive, especially as interest rates were rising, because of course, as a buyer of real estate, I'm very concerned about interest rates. Of course, we buy our properties with leverage, as everyone does. So we instead turned to Alberta, and we started acquiring apartment buildings in Alberta, where cap rates were much, much higher. So I'm going to realize a much, much better cash flow on those assets relative to something I can pick up in maybe the GTA, where cap rates are going to be very compressed, right? So we will change our strategy and pivot within our mandate to benefit our investors based on what we're seeing at a given time.
Nice. So let's just say somebody, of course, the minimum fund is about $5,000 for the funds, and then $25,000 for the development side. Let's just say somebody, doesn't have too much money for a down payment for a property, or if they already leveraged out on multiple properties they have, or they don't have any money left into their savings, but they have money in their, let's just say, RSPs or liras. How would they be able to leverage that in order for to get into something like a company like Equiton?
Yes, I would say that this is by far the most common way that my clients invest. Most of my clients, Dilyar, they're like me. You know that I own multiple real estate properties. I love my physical real estate. I have no intention of selling it. But I have all this money in an RSP and in a lira from maybe a former employer that I can't invest in real estate. It's locked up in a tax exempt account, and that's great, but I'm not able to use it in an asset class that I like. The nice thing about Equiton is that we can actually put that registered capital to work. So we can accept investments in our funds and in our developments from TFSAs, from RSPs, from our ESPs, LIRAs, all of these types of tax exempt investments. We can offer exposure to physical brick and mortar real estate with. It is a very simple process. I think maybe beyond the scope of this short conversation, but it's actually something handled by me personally on behalf of my clients. It's a very, very simple process.
Nice. So they wouldn't be taxed if they take out the RSPs or ESPs like if
No, you're not taxed at all. And the reason why is because you're not actually taking it out. The investment sits in the account, just as a mutual fund would sit in the account or a stock or whatever your investment choice would be. This would be the exact same thing.
Okay. And as you mentioned that of course $5,000 is the minimum starting point for the funds. Now, what would you recommend starting off? Because I know 5,000 is sounds good and everybody can invest, but like what would you say like a sweet spot, like a good number would someone would want to start investing into a fund? Because the development is 25,000. So anyone who has 25,000 they can also do the development, but as on the fund side, like where would be like a good sweet point that you've from your experience you guys seen that you can kind of see a good leverage, I mean, good
Yeah.
return on investment on.
I think, well, first of all, the amount of profits you receive, of course, is commensurate with the amount you invest. Someone who invests $200,000 is going to make a lot more money at Equiton than someone who invests 5,000.
Exactly.
I don't choose to approach my clients that way. Um, my approach to clients is a personal one because everyone is different. I have clients with me, Dilyar, that have $2 million with us. I have
Mhm.
clients with me that have $5,000 with us, and
Mhm.
everything in between. And what's suitable for one person isn't going to be suitable for someone else.
Mhm.
Um, my approach to clients is first, we do an educational session where I'm bringing them up to speed on what we do here, who we are, our history, how the investments work, their strategies, their risks, their returns, because they need to be armed with education to make an informed decision. Second thing we do is we discuss financial matters, right? Where are you financially in your life? What type of disposable capital do you have? Do you have a TFSA that you're looking to invest, or do you have an investment corporation? Because the tax implications of our investments they differ across all three. So that will actually help me advise them in terms of what I think they should do. But really, it's a top-down educational approach where I'm learning more about the client, and only then can I make a recommendation. Because what's good for you may not be good for me. Right?
Absolutely. Do you guys have any new projects that are on the works right now as in the development side?
We do. This is an opportune time to be having this discussion. We actually launched our second development back in Canada Day, so about 5 weeks ago. It's been very well received so far. We're already 50% allocated.
Wow.
Um, the project in question is an 11-story condo in Etobicoke, so it's in the west end of the city, Toronto,
Nice.
and specifically, it's located on the Queensway between Islington Avenue and Royal York Road. The
Yeah.
reason why this project is so popular is because of its term. It is a very short project, which is extremely rare for a Toronto-based condo. Typically, Toronto-based condos take anywhere from 4 to 7 years to build, depending on the scale.
Yeah.
This project is targeted to go only 3.25 years, 3.25 years. And the
Nice.
reason why is because we already have the zoning approvals in place for this build. So
Nice.
it is not only a shorter project for that reason, but it's actually a relatively low risk one when we consider other developments, because we're not going to be spending a lot of time bogged down in the approval process when we're negotiating with the city. Most of that is behind us, which is quite nice. Um, People also really love investing in Etobicoke. Everyone I speak to about Etobicoke likes the area. They know it well. It's a very, very popular project. I always recommend for clients, if this is your first project in developments, you've never done something like this before, you're still learning about how these types of investments work. This project is a very good starter one, just because of how simple it is. It's very short, it's relatively low risk. It's easy for someone like myself to educate and explain. Whereas other projects we do may be a little longer, maybe a little more riskier, and maybe a little more complicated. Now, and so maybe we'll leave it there. But as I said, we are about 50% raised. We're currently looking to raise about 23.5 million for this project. So the way these developments work, Dilyar, is we only need a certain amount of money. So for instance, for this project in question, the name of the project, by the way, is Vicinity. For Vicinity, we need 23.5 million. Once we raise 23.5 million, that's it. No one else can invest. We proceed with the building of the project. We proceed with the development. and no money comes in or out from that point onward. Okay, so they are somewhat limited time opportunities,
Nice.
but still lots of room to invest.
So the project already launched in Canada, you said? So about
Yep,
5 years
we
ago?
launched it on Canada Day, so July 1st essentially is when we launched. And like I said, we've raised about 12.5 million so far. We have about 12.5 approximately to go. Now, the term of the project, as I said, 3.25 years. I didn't ever discuss the returns. Earlier in our conversation, I mentioned that developments have annual returns around the 20% mark. That's what we target. And this project is no different. The total targeted return on investment, the ROI for Vicinity, is 65.1%.
Wow.
Okay, so, and if you divide 65.1% by the 3.25 term of the project, you'll get your average annual return of 20%.
Nice, nice. So this project is again, it's 50 you said 50% already been sold out and you have another
Yep,
50.
it's 50% allocated. That's right.
Okay.
And I just wanted to clarify something, Dilyar. When I say we're doing a development investment, we are physically building the asset ourselves. We're not selling pre-construction condos. When a client makes an investment with me in a development like Vicinity, you're investing in the physical construction of the building. In fact, our exit strategy is selling the units pre-construction.
Yeah.
So it's like to think, oh, I'm buying a pre-construction condo unit. I'm getting in at the ground floor. I'm getting the best possible price.
Yeah.
You're not getting in at the ground floor. You're getting in number two. We are number one. We're building it, right?
Yeah. Yeah. So you guys are the developers basically, and they're funding the
Exactly.
project.
We are the developers, and we also raise the capital. We do both.
Yeah. Well, this is interesting because I know a lot of people when they talk about real estate investment, they just think physical, brick and mortar. They have to go and get a down payment and then purchase a property, qualify for a mortgage,
Mhm.
sometimes deal with tenants and pre-construction, whichever. There's different avenues, and a lot of people are not really familiar with this type of avenue. That
Exactly.
that
And those are more traditional avenues. And again, they're fantastic. And you know that I own properties too. These investments, the ones I'm speaking with you about today and members of your network, these used to only be available to super high net worth people, the one percenters of the world, and
it is, right?
institutional investors. Like if you're a pension fund or if you're a university endowment, you would engage in this type of investing. Now, changes in regulation within Canada have actually come way down so that everyday people can participate. And that's why we're now bringing these types of investments to the masses. But most of my time, Dilyar, is just spent educating people because folks don't even know that they have these options available to them, right? They've never been taught that. They've been taught their whole lives to contribute to an RSP, invest in a mutual fund or in a stock, and that's what they've been taught. And so most of my time is spent sort of reversing that knowledge because there's far superior ways to make money in this real estate world.
Absolutely. Yeah, that's our job, right? Is to educate our clients and the people as the best way as we can do because there's, as you know, there's a lot of noise in the market right now and all around just saying real estate this and real estate that. There's a lot of stigmas around as well. But of course, you know, there is a lot of different avenues of investing in real estate. And again, I thank you for coming onto the podcast once again. I know that you came in a little bit of short notice, but thank you once again. And if you guys where they can find you on your social media or your
Yeah. So my email address is lraponi,
Mhm.
RAP as in Peter, ON as in Nancy,
Yeah.
at equiton.com. But
Mhm.
if you're looking to get a hold of me personally or a member of my team, the best way to do it is just to go to our website, www.equiton.com. You can go to the retail section of the website and you can see a complete list of everyone on my team, and of course, myself included. And there's also links on the website to book a meeting with either myself or a member of my team.
Right.
But in terms of if you're interested in speaking to me specifically, what I would recommend is that people reach out to you, Dilyar, and then you can actually just connect them with me directly. That would be the best way.
Absolutely. And I'll leave your information on the link below.
Perfect.
Yeah, well, again, once again, Lawrence, thank you so much for coming onto the podcast today. I hope you guys found value in our conversation. And if you do, please hit the like button and please subscribe and share on your social media and to your family members, of course, if this has found value too. And hope to see you guys in the next one. Thank you so much.
Just mine. Take care, Dilyar.
Take care.